Can we go much lower than this on yield, do you think? Is there a lower bound?
Well, yeah, sure. Eventually, although we've seen negative rates in Europe and Japan, so zero is not necessarily a lower bound. But Matt, you remember over a year ago, my target for the 30-year Treasury was 2%, and the 10-year was 1%, and we're closing in on both those numbers fairly rapidly.
But do you think when we hit those numbers then that we'll turn around and yields will start to recover again, or?
No, I don't think so. It depends very much on what's going on in the world. If we're moving into chronic deflation, which I think is the odds-on bet now, yields could probably stay low. If you had 2% nominal yield on a 30-year Treasury, and let's say you had 2% deflation, that would be a 4% real yield, which by historical standards is very high. But what I dubbed actually 1981 as the bond rally of a lifetime, and the yield on the 30-year bond then was 15.2%. That would be over. And I have up until now never bought long Treasuries for myself or our accounts we manage for yield. I couldn't care less what it is as long as it's going down. And that's what's really meant that Treasuries have outperformed the S&P by 6.5 times since the early 80s, and it's been appreciation. It hasn't been yield. So that's what really has mattered to me, and I think this bond rate of a lifetime is still intact, but we're out a lot closer to the end than we are at the beginning, obviously, at these rates.
Gary, and I want to talk about the flattening yield curve, of course, because we're now seeing the 2- and 10-year spread just tightening at the tightest since 2007. We can see the areas in red that we're actually showing right now to our viewers are areas where we had recession. Do you think this is forecasting a recession soon?
Probably not. Actually, I'm talking about then just completing our July newsletter insight, and that's why I'm not in the studio. I'm in our office writing. But it's very different. Normally, that yield curve inverts with the short rates above long rates because the Fed has gotten worried about an overheating economy, jacks up short rates to the point they exceed longer rates. If we get a flat or even inverted yield curve this time, it's quite different. It's just that the Fed would be reluctant to go negative on short rates while you had investors driving down the yield on Treasuries. And Treasuries are, longer-term Treasuries are attractive, 10-year notes, 30-year bonds, because it's a safe haven, because the yields are low as they are higher than they are in most developed countries. So foreign investors get a higher yield here, and with a stronger dollar, they get a currency translation gain to boot. And a lot of foreigners see this as a safe haven. And again, if we're headed for deflation, it's another reason. So I think the long-term yields coming down will further flatten the yield curves. And by the way, that's very, very tough on the banks. You know, banks have been basically busted back to sped lending. They've been bereaved of all the profitable origination of securities, of derivatives and trading, proprietary trading, and so on. And spread lending is not really that attractive, and particularly when the yield curve is flattening and those spreads are getting compressed.
Let me ask you, Gary, about stocks right here. I've got up a chart. It's 1925 on the Bloomberg, so #BTV 1925. Joe Weisenthal put it together this morning. It shows the yield on 30-year Treasuries going down below the S&P 500 dividend yield. Shocking to me, but is this a sign that investors might want to get into stocks here as it's paying more than the 30-year?
Well, you know, the question is, what is the yield telling you? I mean, I've got to say that I don't know how this is going to come out, but I think if we look back on this in another 5 years or so, we're going to conclude that this was an extraordinary period, and it was foretelling some things that we don't really fully comprehend. But if these low yields, among other things, are foretelling that there's some big problems out there, then the dividend yields on stocks is not safe. In other words, you could get that compression because of dividends coming down. Of course, yields could go up as stock prices go down, but dividends could be cut as well.